All right, let's talk about loss aversion and why losing money hurts more than gaining that same amount of money feels good. Tons of really great research on this. People like Daniel Kahneman have done research on this. Economists have, psychologists have. Let's delve right into one of the most important psychological components or behavioral components of investing, which is the idea people tend to value gains and losses on their money differently, even when we talk about the same amounts. This has to do with something known as prospect theory or loss aversion theory. And it was developed in part by economists Amos Tversky and Daniel Kahneman. We've interviewed many former colleagues of Tversky and Kahneman on the program before, like Baruch Fischoff and others. The idea here is that people perceive the probability of a gain as greater than the probability of a loss. So when you consider, for example, let's imagine you are going to put, we'll put it in the middle here. You are going to put $10,000 into a stock. You're imagining, what would it be like for that to go 10x and grow? And you're envisioning that more than what would it be like for it to lose 90% of its value and be worth only $1,000 versus $100,000, okay? You're thinking this through. In theory, it's just as likely that a stock could go up a huge amount as it is that it would go down a huge amount. But humans tend to perceive the probability of the gain as greater than the probability of the loss. And what prospect theory proposed to explain was why expected utility theory really doesn't work. Expected utility or expected value is not sufficient to explain human decision-making patterns, because utility theory assumes people are completely rational with what to do with money. If you've been watching this channel, you would probably suspect that's not actually the case. Prospect theory or loss aversion theory overlaps with something called the certainty effect, which occurs when people prefer certain outcomes to probable ones, and what's called the isolation effect, when individuals will cancel out similar information that they may like less when making a decision. And this also, in part, explains why people fall victims to things like the endowment effect or the sunk cost fallacy. Let's talk about those. The endowment effect is when you place a higher value on something you own versus something you could acquire but do not own. You assign more value to the thing you own than the market does because you have it. It's already yours. It can be a dangerous bias to have because it suggests you're not being rational about what you have, and the market could continue to assess it lower and lower while you think it's more valuable than it really is. And the sunk cost fallacy is when you're reluctant to abandon a strategy because you've invested into it. If you own a stock and it keeps going down, maybe there's good reason for it going down. The fundamentals have changed, our outlook or whatever. You hold it, or maybe you even buy more because you already are invested into it. That's the sunk cost fallacy. We see this in society a lot. You go to a movie, the movie's 3 hours long. After an hour, the movie's a disaster. You might stay because you bought the ticket, even though you might get more enjoyment out of spending the next 2 hours doing something different other than watching the movie. Either way, you spent the money on the ticket. That's an example of sunk cost fallacy. Or pursuing, if you're working on 5 different areas in your business, it's just not going well, but you're already invested into it. So you keep going simply because you've already somewhat invested into that area of your business. These are sunk cost fallacies. They can cost a lot of money. So that gets us to the concept of loss aversion. And it's integrated now into financial planning, into investment advice. And financial advisors use loss aversion to help clients make better investment decisions. So to look at another example, if we go back here a little bit, if we were totally rational, if I said to you, here are your options, okay? I'm going to give you $100, or I am going to give you a coin flip where you either win $200 or you win $0. Statistically, because it is a 50-50 shot with a coin flip, the expected value of this 200 or zero is $100. You have a 50% chance of one, 50% chance of the other. The expected value is $100. Most people choose the certain $100. And this goes to that certainty principle. So the way that a financial advisor might talk to you about this is they would say, if the investments you bought lost half of their value, what would you do? Would you sell? Would you buy more? Would you do nothing? These scenarios can convince people that there's a higher likelihood of investment loss than initially perceived, and it can help them better tailor their investments to their risk tolerance. Another way this is often used in investment decisions is that having lost money in an investment can turn you off from wanting to invest in the future, because these losses create mental fatigue. You may say, why did I even get involved to begin with? Maybe the loss was a bad decision. You didn't accurately weigh the risks. Maybe it was a sound decision, but the market happened to be in a downturn and was behaving irrationally. In either case, you shouldn't let it discourage you from investing altogether, as long as you are poised to earn more than the cash would earn sitting under your mattress. That's the important thing. Certainly, all of these psychological factors play a role, so it's important to know about them. All of the factors go to show why it doesn't make sense to put a ton of your assets in individual stocks, which can have these huge up and down swings. Instead, if you buy low-cost, broad-based index funds in tax-advantaged accounts, hold long-term, don't try to time the market, don't try to beat the market, you will be way less susceptible to any of these biases and of perceiving your losses and your gains differently.